Happy to take a couple of questions, either about Quincy or about the market, and then we'll have a little networking. After a while, we have the room till 11, I think, but any questions, happy to answer them. Where do I see the market going next 12, 18 months? I think the market, I am hopeful that the market starts to turn at some point next year. I think it's likely it'll be the second half of the year. I hope it's the first half. But I think there's a lot of issues. There are a lot of issues that we have to work through to get through this. And namely, these mortgages that are going to mature that can't be replaced, we have to get through that and deal with it all. And that's a big issue. So I think relative to the secondary and tertiary office market, I think that one is going to take the longest to recover. But I think that we're in a position where hopefully we start to see some positive things happening. You know, again, I think it depends. It's going to be sector by sector, but I'm hopeful that at some point next year things start to turn around a little bit. And I think the first sign that the Fed, even if they just drop rates 25 basis points, I think that's going to be a positive sign for the market. Now, that's not saying everyone is going to be saved, bailed out. There's still going to be a lot of working through these over-levered properties that we have to de-lever, but I think that we can get back on positive footing once we see that rates aren't going to continue to just keep escalating. The question was about retail and our businesses coming back. I think we've seen a lot of the retail activity has been in the food and beverage sector. That's been an overwhelming percentage of the deals that have been done. And I think businesses will come back. I think that there are new businesses. A lot of online businesses now want brick and mortar stores. So I think the nature of retail is changing. We talk about experiential retail, where people want to go not necessarily just buy stuff, but have an experience. So I think the world is constantly changing and adapting, and I think retail will be used a little bit differently, but it's positive to see that most people believe retail rents have stopped going down and leasing activities picking up. Those are the positive things. Yeah, you know, I wish I had brought the pipeline numbers with me. We have that. And let me see, is Ryan here? Ryan, any recollection what we have in, for instance, the condo market? Okay, but it's several thousand units are under construction and coming to the market, but there's a pretty substantial pipeline for every property type. Whether you look even the rental market, where I said there's a huge air bubble forming because no land has really been sold for rental construction recently, but there are a lot of projects in the pipeline. So we'll be coming out with that within the next week or so. We'll send out to everybody. I think everybody here is on my distribution list. We'll send you what the pipeline is for both actively under construction and planned for each of the different product types. But there is a lot, and so shockingly a lot. If you look at the combination of actively under construction and in the planning or pending stage, there's about 84 million square feet of new projects in Manhattan alone. Yeah, the question is Local Law 97 and how that's going to impact the market and valuations. It is a very, very impactful thing on the market, without a doubt. It's basically another tax, the way I see it. And in the office sector, where most people are talking about Local Law 97 relative to office, although it impacts all property types, we have a scenario where owners are really not focused on it at the moment. Most owners of B and C office buildings are trying to figure out whether they're still going to own the building next year. Forget about having to put money in to comply with the law that you have to comply with in the future. But it is a tangible cost, a big cost. Local Law 97 is projected to raise about $900 million by 2030 in additional fees and taxes that are going to have to be paid. So it will have a profound impact on the bottom line operating of buildings, without a doubt. Yeah, I think typically folks who buy debt want to get at the asset, and I don't think that has changed at all. And so what we've seen is there are a number of folks who are very interested in buying debt today. I think over the coming months, we're going to have more and more notes coming to the market maybe in a more open fashion. I think that's loosening up a little bit. But yeah, folks who are buying debt want to get at the fee interest of the property. Yeah, I am not an expert on the office sector. By far, a leasing broker probably would be better to talk to you about that. But I do think that at least from my perspective, and I'm in the older generation, I guess, of folks who go to the office. I'm a 5-day-a-week in the office guy, which I never thought I would be again. But I don't think I would not be comfortable in a hoteling environment. And if you're not going to have a hoteling environment and you're going to have a dedicated workspace, whether you're in the office 1 day a week or 5 days a week, you need to have dedicated space. So I think that for companies, aggregate demand is going to be impacted by how companies perceive they need to use the space, and do they need to have all of their employees in the space. I know that if I was still running MK, certainly I'd want all my sales people in the office every day. Would I need to have my graphics people in the office every day, or my research department in the office every day? Could they work from home? Potentially. But I think we still need to see what's going to happen with aggregate demand and net absorption. I always say, if you look at a company signs a lease for 100,000 feet, you don't know whether that's a good thing or a bad thing. If they came out of 50,000 feet, it's a great thing. If they came out of 400,000 feet, it's a bad thing. So we need to see how the absorption trends are going to play out over time. The question is, how far are we away from it making sense to tear office buildings down? We see a number of properties, secondary, tertiary buildings, selling in the mid-300s a foot. We think once values get down below 300 a foot, typical cost to demolish a 20-story office building is going to be about $75 a foot. So if you're at $375 a foot, that's less than land value, in my opinion. So we're getting there. It's not quite there yet, but if you look, there's a building that notably has been in the media, 650,000 foot building. Based upon what that building is going to sell for, I believe it's a land sale. I think that the buyer will be buying the property for land. They're going to knock down a 650,000 foot building, build a new building there. And economically, that's going to make the most sense. So I think we're getting there. It's there in a couple of cases. Generally, we need the market to continue to come down, and I think it will for those types of assets. And so I think you're looking at land value for those deals. Any relief from the courts? Well, unfortunately, the Supreme Court decided not to hear the constitutionality case about rent regulation. So I don't know what other legislation is pending that could potentially help us. But what we need to solve the problems in the city, we need everybody to become more active in terms of voting. The biggest problem that we have in New York is voter apathy. 14% of registered voters vote. That's why we have the policymakers we have. And again, why is it so hard to understand that if you look at housing, for example, that the solution to all of our housing issues are simply on the supply side? Again, every politician says, we want New York to be more affordable for everybody. So let's say you are one of those elected officials that believes that an Econ 101 textbook is capitalist propaganda and that it doesn't work. Well, just look at the pandemic. People left the city, vacancy rose, vacancy rising is tantamount to increasing supply. Rents in Manhattan dropped by 30%. Increased supply. How do you do it? You do it easily. You bring back a 421A, Affordable New York. You reconstitute the IAI and the MCI. How politicians don't get this, I don't understand. And I use as an example, you look at our housing market and how profoundly impactful the MCI and the IAI programs were. It saved the city. Those programs saved the city. 1977, Yankees, Dodgers, World Series, Reggie's hitting all the home runs, Goodyear blimp pans out, 6 fires going on around Yankee Stadium. Howard Cosell says, Bronx is burning. Why was the Bronx burning? Bronx was burning because there was a 14% dilapidation rate in New York, meaning 14% of our housing units were uninhabitable. And it made more sense for people to burn their building down, collect the insurance money, than to invest in it. So the city creates the MCI and the IAI program, and what happens? The private sector dumps tens of billions of dollars into the housing stock because they had financial incentive to do it. And what happened in 2019, that 14% dilapidation rate had dropped to 0.04%. Better quality of life for people, better living conditions, better housing stock. And so what did the policymakers do in 2019? They said, oh, let's marginalize those programs. How could you do that? How do you create a disincentive to invest in the housing stock? And one politician who I sat next to at an event didn't know I was a real estate guy. We're talking about this. And he says to me, well, I did vote for that, but by the time the buildings really get into bad shape, I'll be out of office, so it doesn't matter to me. How do you deal with that? So bring back the IAI and the MCI. Institute a new 421A or an Affordable New York. Raise the 12 FAR density cap. State has to do that. Implement a citywide 421G program to incentivize the conversion of older, obsolete office buildings. You know, so many things can be done, but it's all on the supply side. But we're not getting any help from our politicians. So is there any help out there from the courts? It has to come from us becoming more involved in the process of determining who our elected officials and policymakers are. So the best thing you can do is vote, encourage the folks you work with to vote, your family, your friends. We can't have 14% of New Yorkers vote and expect things are going to get better. Yeah, the question is relative to debt, what is the average discount? I don't know, simply because there hasn't been enough visible trading in that space. So TBD, we'll keep you posted. I think there'll be more visibility into that over the coming quarters, but we don't have a lot of visibility into it at this point. Yeah, Ken, I think that the slowness of the courts is just part of the landscape here. And I will tell you that one of the reasons why I mentioned the multifamily investors are buying around the country now. I was talking to one client, and he said, Bob, I have to tell you, I love buying in Indianapolis. And he said, my property manager called me up and apologized that it was going to take an extra week instead of 2 weeks to get a tenant out for non-payment. It was going to take 3 weeks because the sheriff was on vacation for a week. And he said, the manager's apologizing, it's going to take an extra week. And he said, I'm sitting here laughing that I'm going to get possession of my apartment in 3 weeks. This is great. But it's unbelievable how different things are here than other places. All right, everybody, time for another cup of coffee, a little networking. But thanks for coming today, and look forward to chatting with you soon.